Good afternoon, everybody. Thanks for joining. My name is Loomba. I'm the host for today's meetup. I'm a founder and CEO of Loomba Investment Group. I'm in commercial real estate investing space with special focus on multifamily investing. I love to help people and educate people on real estate investing. Some information on the passive income or the mailbox money as well. I host meetups every other week on Fridays and bring some interesting topics on real estate syndication as well as investing, and bring some great, awesome guests who are the SMEs or the subject matter experts. I'm always seeking for investor partners and love to build strong relationships. And if we are not already connected, please feel free to reach out on social media, LinkedIn, Facebook, Insta, and connect with me. And also, you're welcome to go to my website, loombainvest.com, and feel free to download the free ebook, 7 Reasons Why Real Estate Syndications Build Long-Term Wealth. So before we get started today, I have a small little disclaimer. This presentation is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This presentation does not represent an offer to sell or a solicitation to an offer to purchase an investment or security. The strategies mentioned in this presentation may not be applicable to everyone, so please consult your own attorneys, financial advisors, or CPAs for any legal matters, investments, or any tax-specific situations. So today's our topic is on capital raising, and this is the most popular topic in today's date, especially in real estate investing. Today, Admin Chain's with us, and he's expert on that. He's going to break down and demystify this high-level investor class and teach us the complete framework from prospecting to connecting with this market segment. About Edmund. Edmund is a retired private equity manager and former licensed stockbroker. His main area of focus is in real estate syndications and multi-generational wealth transfers. Most of his time was a client-facing capital raiser and investor relations specialist. He has managed money for family offices, lottery winners, multi-generational accredited investors, and NCAA athlete. Today, Edmund is retired from the financial industry and coaches real estate syndicators on how to raise capital from accredited investors. So welcome, Edmund. Stage is all yours. We are so delighted to have you with us today.
Yeah, it's my pleasure being here. I have to apologize ahead of time if I'm kind of choppy. I've realized that my video is usually not the greatest. I'm way out in the country. I kind of live on an estate, and it's way out in the rural area. So you'll have to excuse me. Hopefully the sound is okay, or my video quality is okay, and you can sort of hear me. But I guess the first part, Vinky, what you and I were talking about is we're talking about different types of raising capital. First off, what we want to establish is that we're talking about accredited investors, which is a 506c raise. Right, so there's a big range in that area. So when we talk about accredited investors, the first thing that I do is start to slice the category. If you haven't heard some of my other videos, like there's a couple of other YouTube videos or podcasts that I've done with other people. But the first thing that I do when you're setting yourself up to raise capital in a 506c, I guess the first thing that I want everybody to understand is that when it comes to capital raising, it's essentially like financial services sales. And in order to be successful in this arena, one of the key fundamental characteristics that you need to have is this characteristic of empathy. And empathy is not to be mistaken for sympathy, right? Empathy is understanding the world from another person's perspective. And that's where really good sales begins. So it begins with the person that you are prospecting and understanding what it feels like to be them, right? So a lot of times I come across people that are relatively new to sales or relatively new to capital raising, and they go into it guns a-blazing with their deal. And it's all done from their perspective, and they are broadcasting out into the world, but they're just broadcasting and they're just kind of like throwing it up against the wall and seeing what sticks. But the thing is that you don't understand the person that's on the other side listening to that, right? So that's really where we begin. All right, so let's take a couple of steps in that direction. The first thing is, let's take a look at the accredited investor space. And if we take a look at just the investors alone, just the accredited, we're not talking about institutional just yet and pension funds, but let's talk about just the individual household that's accredited, which is $1 million worth of investable assets, excluding their house, or $200,000 worth of W-2, all right, for the last 2 years. So the first category, what I like to do is I like to slice that a couple of different ways. The first is there's different categories of accredited investors. They're not all created the same. First off is you have an accredited investor that is what I call newly accredited, right? So they're either newly accredited or they don't know they're accredited. So the people that maybe last year were worth 950,000, today just broke over $1 million. I didn't realize that they hit this new threshold. All right. So these are newly accredited or accrediteds that didn't even know that they are accredited. Okay. So I see Jane is asking a question about 506B. So I'll take a quick pause here and answer your question, Jane. That's a very good question. For me, there's a reason why like I started day one. So I've got 20 years in financial services experience and coaching. And from the beginning, I was accredited investors only. So for the American equivalent, I was 506C from the beginning. And if I take a look back at 506B and non-accredited or sophisticated investors, the first question I would ask is, why are you there? And if the answer is, and this is the common answer I get, is when people want to just think it's a prerequisite, and I should really start and get comfortable with it first before going into 506C. And I'll tell you why that is not necessarily the case. If you're in 506B, and the analogy that I use is if you take a $50,000 investment from somebody who's not accredited versus a $50,000 investment from somebody who is accredited, you will be taking more of their percentage of their net worth. And you have a higher fiduciary responsibility, and it takes a lot more effort in investor relations for a smaller amount, right? So to give you an example, when I was managing money, one time I was calling one of my clients a year later after he made an investment. It was a $50,000 investment. I called him a year later and he said, wait a second. So what was your name again? And how much do I have invested? I was an accredited investor. And I tell people, it's like, well, at that point, my fiduciary responsibility went to zero because he didn't even remember he had the investment with me. He couldn't even remember my name. If you're in a 506B and you took $100,000 or $50,000 investment from somebody who's worth $150,000, you can sure bet they're going to know who your name is and they're going to be calling you every week. So in some instances, raising capital in a 506C is easier, in my view, than it is starting with 506B because it takes a completely different skill set. There's a lot more hand-holding when you get to 506B, right? So that's my point about that. So I think that the good starting point, if you're relatively new to capital raising, is start with newly accredited. So people that may or may not realize they're accredited, maybe they're up to 1.5 million in net worth, right? That is somebody who most people can start to relate to, right? So maybe up to about 2 million. Once you start to get beyond 2 million, the reason why I picked 2 million as a threshold, if you have $2 million in investable assets, you're most likely not going to be at a discount brokerage firm managing your money yourself. But if you're newly accredited, you possibly could. But if you get to 2 million, you're most likely going to have an investment advisor at JP Morgan Chase, somebody because you become a good candidate and you are in the sweet spot for investment advisors. That's a perfect account for them. So they're constantly searching for the $2 million accounts and above. And now when you're raising capital from somebody who's worth 2 million, you're up against an investment advisor, a really good qualified investment advisor, probably at least have 5 to 7 years experience, if not more. Then you get in that space, you're probably at 2 million to 5 million. Once you get beyond 5 million, that's another category of accredited investors. So 5 million plus, you're starting to get to an investment advisor. You're gonna have a tax accountant. You're gonna have a tax lawyer, possibly even a private equity person in there. You're gonna start having more and more professionals and specialists that have $5 million account and above. Once you go beyond 5 million, you get to maybe 5 to 10 million. Now 10 million plus it starts getting into more like a family office feeling. It has multi-generational aspects to it. You've got to have a really good answer for intergenerational wealth transfer. There's probably a life insurance person involved in there. There's a lot more professionals. So it starts becoming a little bit more complex, right? So if we're talking about tonight, if we want to talk about how to get to the mid-level, all the way up to the high level to starts bleeding into or turning into family office. If we're going to focus in on that tonight, then there's a couple of things I would like to sort of explain. All right. So let me just check. I saw some questions coming in here. Let me see. Jane, 506B. Thanks, Tom. Exclusive. Yeah. So 506C, that's not really our focus tonight, Jane, but 506C can be advertised to the general public. That's another reason why I like it. So there's less scrutiny from the SEC because you don't have to show a pre-existing relationship, right? So that's another thing too in 506B, pre-existing relationships like friends and family, that can be problematic as well as an investment advisor. So when I was managing money, I had my mentor explain to me, it's Ed, don't ever manage money for family, like you're excluding your direct family, but don't manage money for like your aunt and your cousins. That's usually doesn't go over well. It can make Thanksgiving and Christmas a little awkward at times, right? So try to avoid those types of things, and that's why I like 506C, right? So let's take a look at the mid-range accredited investor all the way up to family office. And Trevor keeps telling me that, or sorry, go ahead. You have a question, Vicky?
Yeah, I was just going to ask you, can we start from the framework, like talk about that, there might be some brand new people who wanted to learn how to do their first raise even, so the kind of the framework around it, like how to reach out to people, if you're just barely new, to make those kind of connections and raise capital from the retail investors, because you want, like you say, you got to be a salesperson in order to be a good capital raiser. So you need to make some kind of strong connections, whether you're doing 506B or C, regardless, B, you might have the connections within the family and friends. But if you're doing 506C, you can advertise, but you still need to build that trust relationship in order to get that money on the table. So I was thinking if you have some framework around that, how to go about that and how to establish those strong relations so that, as people are stock meeting, they're bringing the money on the table when we need it.
Okay.
And we move to the mid to
we
high
can absolutely do that. Sure. So if this is, say, this is going to be your first race, right? The first thing you've got to ask yourself is, well, the first thing you got to know is, and I kind of go back to a concept in Sun Tzu, The Art of War. So Sun Tzu, The Art of War, one of the concept is know yourself, know your enemy, and know the terrain. And if you know all three, then you have a much higher percentage, if not for certain success. But if you only know one of them, you're only going to be successful 1/3 of the time. You know, two of them, you're only going to be successful 2/3 of the time, and so on and so forth. So the first thing to know is know what your raise is, right? So how much am I raising? What is it for? What is my pro forma? What is my investment return? What are my cap rates? All the kind of like high level basics. How long is the hold? All those types of things, right? That's sort of the first piece. So know a little bit about your deal, know a little bit about your offering and why people would care, or why would that be important? The next is know your terrain, is know the investors. What are the investors looking for? So when I work with clients, when I coach them, we really have to go and kind of narrow down into what we call an ideal client or a client avatar. And the reason why that's important is because you want to be able to, if you broadcast too broadly and you pretty much, and this is counterintuitive. Most people say, well, I want to raise capital from anybody, so I'm just going to broadcast, this is a real estate deal. If you broadcast to everybody, you will interest no one, because if each investor investor profile will have different pain points that will catch their attention. So if I'm trying to pitch to a high net worth client, for an example, my usual default when I was pitching to a high net worth client was tax savings. All right, so income tax savings on essentially a W-2. In Canada, we call it a T4, right? So if I can show you how you can save on income tax, then that's usually my lead off. Now, if somebody has income of $30,000, they're not paying that much in income tax. They don't really care. They don't really know. I had clients with a W-2 or W-2 equivalent of $1 million, literally 7 figures. So if I said like, oh, I can, and so they're paying in Canada, they're paying about $500,000 in tax a year. So if I have a solution for tax, I swear that guy will like clamor over a table to come across the room to hear whatever tax trick I have, right? That's an example of knowing those pain points. But if somebody has $30,000 worth of income, they could care less. They're just going to glaze over when I start talking about tax because they don't care about that. So that's just an example. And if you start talking about, well, real estate can do this and real estate can give you 7%, if you've got an investor that is currently making 18% in something else, they won't care. So you really have to know their perspective. What are they currently invested in? Why are they currently invested in that? What are the risk levels that they're in? What are their pain points? And if you can and you can pick if you can pick a category where their pain points, you'll start to notice they'll have a consistent pain point between everybody in that range. So go back into my example, if you have newly accrediteds, there's a particular pain point that newly accrediteds will have. And then there's a different pain point that a 2 million to 5 million person will have. And there's different pain points for 5 million to 10 million, right? And they all kind of change. And that would change the way that you broadcast to them, right? So just to give you a rule of thumb, the higher the net worth the individual, the more principal preservation is important, okay? So if somebody has like $100,000, they're probably going and they'll be investing in Bitcoin and all these like high flyers, things that for massive growth. But if I come across a portfolio that's $10 million, I'll start to say things like the number one thing we want to do is make sure we don't lose the principal. And that gets big check marks and I'll catch that person right away. But if somebody's got, if somebody's got $200,000, I say, oh, the first thing we want to do is make sure we don't lose your money. I said, well, how are you going to get me 10% return, 20% return? They care more about growth right now because they don't have it. Once you have it, you care more about not losing it, right? And then we start talking, and that's why tax becomes kind of important. So the first thing to do is understand or pick a client avatar. And once you pick a client avatar, go and somebody's eating chips or something. Kind of get some, I got some static here. All right, so, oh, thanks. Once you pick a specific avatar, get to know that avatar very well. And that's kind of the difficult part, that it's really best to work with a coach or a mentor to help you decide, is my avatar too specialized or is it too broad? Because you want to pick something where there's a lot of them, there's a lot of those avatars, and you have an ability to be able to close that group. All right. So keep in mind, if you're going to pick 506C and you're going to pick accredited investors, that's 6% of America right now, right? So then you take a look at, okay, 6% of society in America. Now, there's going to be also on top of the size of accredited investor, it's also the geographic location will change. So this gets back into empathy, which is if you're dealing with an accredited investor, one of the first questions after you figure out which type of accredited investor you're dealing with, the next thing will be is, how did that individual become an accredited investor? So how did they become a millionaire, right? Because if you take a look at geographical location, right now, I believe the highest percentage of millionaires in America is in the state of Texas. I think the second highest is California. So if you take a look at an accredited investor in Texas versus an accredited investor in California, they'll have two completely different core beliefs and attitudes, right? So Texas tends to be more intergenerational wealth, long-term wealth, and it tends to be more based in energy, or they're surrounded with a lot of people that have made their wealth in energy. If you take a look at California, it depends. Is it Southern California or is it in Palo Alto, right? So Southern California tends to be more based around the entertainment industry. And if you get to Palo Alto, it's more tech-based. So that is also being able to bridge and be able, what I call, speak your avatar's language, right? So in those three industries, just in those three industries alone, there's a specific jargon that they use. So for me, my specialty in being here in Toronto, it's very similar to New York. A lot of my clients were financial services lawyers, right? So I started to learn legal terminology, and I explained complex financial concepts using legal terms that my clients would understand. And when I started to talk like that, I just naturally attract a lot of lawyers, a lot of high-end lawyers, like Wall Street lawyers, right? And of course, I wouldn't use that terminology or that language if I was in the middle of Dallas, or I wouldn't use that terminology if I was in LA or in Palo Alto. I would pick a different type of language to be able to bridge that gap. I remember talking to, or I was coaching one lady. She was working in financial services, and she was just actually an immigrant from South Africa, and she was a millennial. And she said to me, you know what, I find it really difficult trying to connect with my clients. And I said, well, tell me a little bit more about your challenges. It's like, well, I've only recently come to North America. I'm from South Africa, and I have a very heavy accent, and I find it very difficult because most of our clients are baby boomer men, and then, it's just really difficult for me to get that rapport with them. So I explained to her, it's just like in modern society, there's a lot of things where people about people and their rights and all these types of things. I get it. But when it comes to sales is the responsibility of the salesperson or the investor relations person to make your prospect comfortable with you, right? So I was born and raised in Toronto. But I understand. I look in the mirror, I can tell I'm Asian, right? So sometimes it makes people a little uncomfortable, and I get that. So for me, I looked at it as my responsibility to make whoever I'm prospecting, make them comfortable with me. And I've got some friends in the Asian community. They'll come in, they'll say like, oh, people commonly ask me is like, oh, where are you from? And then I come back and a little passive aggressive. I come like, oh, I'm from Canada, right? It's like, no, where are you really from? And then they really get bent out of shape about that. And it's a little passive aggressive. It's like, sure, if you go out in society and you act like that, and you demand that people speak on your terms and speak properly to you, fine. That's totally fine for you. But you probably, or it's going to be more difficult for you to gain a client like that. So for me, I understand that most people, sometimes they don't know the vocabulary, right? So when I have people ask me, it's like, Ed, where are you from? Right? It's like, I don't take offense to that. They're trying, right? So I just tell them, it's like, well, you know what? It's like, I was born and raised in Toronto, but my parents are originally from Hong Kong, right? So that's my culture. My cultural background is Asian from Hong Kong. And it's like, oh, thank you very much. That's what it's like. Oh, and another interesting note, my last name, Chen, that actually, the Chinese character for money is actually my last name. It's a vocational last name. All my ancestors were financial professionals. And I just spin that kind of conversation. And it becomes more of a positive conversation. And you can turn it that way, right? Instead of making it a negative. It's like, how dare you? Like, I'm from Canada. Like, why would you care anything else? And just get all upset about it. It's like, fine, but you kind of get a little prickly and people leave. So that's one thing, is being client-centric. So I explained to this girl from South Africa, I said, well, if you have a client that is a baby boomer man, and you're a millennial, let me tell you a couple of tricks. It is your responsibility to build the bridge to make them comfortable and build that bridge over to them instead of you expecting them to build a bridge over to you and making you comfortable, because it's your responsibility. You're the representative, you're the salesperson. And it didn't dawn on her. It just blew her mind. It's like, wow. And it's like, and what can you do to make that individual comfortable? Speak their language. It's like, what do you mean? It's like, I speak English. It's like, and I don't mean English. I mean their jargon. So how I became a specialist with baby boomers, and I'm X-Gen, right? So I'm 46. So baby boomers are supposed to be out of my ability to connect. But all I did was I started watching what they watched when they were in their 20s. So all the popular culture, right? So you start watching you'll start listening to the Beatles, you start listening to Elvis, you start listening to, Andy Griffith Show, all these different, like The Sound of Music, everything in the 1950s. Right? And become a specialist in the 1950s. So when I started talking to those clients, I started to pull in a lot of references based on the 1950s. And one of the best compliments that I used to get from clients is like, Ed, sometimes I forget that you're Asian. And people's like, how, that's so offensive. Why would, how, aren't you offended by that? I'm like, no, because when people say, like, because I'm speaking in a certain way that makes them comfortable, they completely forget. They can't even see what I look like anymore because it makes them feel so comfortable. They feel like they're talking to somebody in the mirror, or they're talking to themselves in the mirror. And so I explained to her, it's like, start learning their vocabulary and the things that they talk about and the references that they talk about. And I explained to her, you could totally do this with me. And it's like, I'm a baby boomer, right? So if you watched Ferris Bueller, if you put in references from Dukes of Hazzard, if you put in the references from all these shows I used to watch when I was a kid, it would blow my mind. I would completely forget that you're from South Africa. I would feel like I was talking to another X-Gen, right? So that's how you just build that bridge. So once again, it is, in my view, it is your responsibility to know your avatar so well that you can speak their language, even if you don't belong in that demographic. I think the first thing, or a common mistake that a lot of new capital raisers do, is they try to sell themselves. So if I were to pitch myself, this is what I would say, but is your avatar actually you? Or is your avatar 20 years older than you? And is your avatar significantly higher in net worth than you? And if that's the case, they have a different perspective. And if you just keep pitching you, all you're going to get is another you. You'll get people with the same net worth and people with roughly the same age group, and you will not be able to be effective in those other top higher avatars. So you will not be able to get to the mid-range or the high level unless you are here and you are in that range and you are a $10 million person. In that case, if you are, then just pitch yourself. It'll be pretty easy. All right, is that helpful, Vinky, or you have any other question? Maybe we can go through some questions here too. I don't want to miss everything.
I think this was great. Oh my God, you were just throwing all the golden nuggets. That was super awesome. And I think I have a better understanding of creating an avatar now, because a lot of people, they talk about the avatar, just like focus on your avatar. So it was not sometimes, I would say it wasn't 100% clear what you meant, like I'm from the tech background, I should focus on the techies only. So then I just feel like, okay, I'm not sure if I just wanted to limit myself, or I just wanted to have a broad range of avatars, not just the techie. Maybe I just wanted to work with the business folks or the educators or whosoever comes my way. So this is just like, I would say, more clarity into creating your avatar. So it's just like kind of a more like knowledge-based transaction that's happening between the two, which is pretty awesome. And I think this is like a good start when you're starting from the low to mid-size range. But when you go to mid to high level raise, how would you do that? Like, would you add more bells and whistles or learn more skills? Like how you wanted to impress people or connect with people, or they believe in you that, yes, this is it. This is my person. I want to go to her to make all my investments.
Yeah, that's a great question. Before we get into getting into the next level, or how to level up into the mid-level, one of the things I do when it comes to avatar is how much detail to go into. And this is what I do in my one-on-one coaching with people. I will drill down and work with you on creating an avatar profile. In fact, what I do is I do a primary avatar profile and a secondary avatar profile. Right? And well, sorry, there's a bit of an echo there. So what I end up doing is that I help you create two different profiles, and we go as far as a number of things. And for me, I'll show you an example. What I do is when I work with my clients, I show them some examples of my past avatars, and I can pick them out. So for me, because I've focused in on a specific avatar for so long, that when I go to a social event or networking event, I can usually pick out the accredited investors in the room with relative accuracy almost immediately. It's because I've got about 15 years experience spotting high net worth people or spotting accredited investors. And the reason why I can do it instinctively is because when I walk into a room, I just naturally ask myself, or make it's almost instinctive now. I just take a look at the room and look at the room and see who in this room looks like my former clients. And I just do it naturally. And people that I coach, when I bring them to those kind of events, or people that I mentor, they're so shocked. Like, how did you know that person was an accredited investor? And I can, if I have to sort of pick it apart, I can sort of show people. But for me, it becomes instinctive. It's kind of like how most people drive without thinking about it. And then somebody asks you, like, how did you drive? Is it, well, I put my hand on the steering wheel. It's almost like I do it instinctively. It's hard for me to describe it because I do it so naturally now. But it's, if you spend that much time focusing in on one specific avatar, it just becomes instinctive and you can just naturally do it. So when you want to level up and get to mid-level to up to family office, there is a next levels of skill that you need. This is where, when I was going back to Sun Tzu, The Art of War, this is where knowing your competition becomes important. So it's creating a unique value proposition. So if we take a look at this, just this room alone, there's 45 people in it. So imagine there's one accredited investor and all 45 people are going to pitch that one accredited investor. What are you going to say to make you stand out from everybody else? Because maybe everybody in this room is going to talk about, oh, real estate. Oh, we're buying real estate in Texas. We're buying real estate in Alabama. We're buying real estate in Phoenix, Arizona. And that all sounds the same. So why should that person care? So essentially what it is I explain to people, there's 3 cells that everybody has to make in order to get a check if you're a syndicator. The first cell you've got to make is why real estate. The second cell you've got to make is why real estate syndication versus that individual buying, the house down the street. And then the third cell is, out of all the syndicators they can choose, why you? And for the most part, you've got to ask yourself, how far do I want to go? And for me, the higher the net worth person, the more cells I'm willing to do. So if you're newly accredited, or say you only have $1 million and you're not convinced on why investing in real estate, I may not spend the effort, right? Because if you're just newly accredited, you've almost got to do the first 2. You've got to be convinced of why real estate and why real estate syndication. I don't have the time to expend, to sell you on those 2 points. The only thing I want to do is tell you why me and present to you my unique value proposition. Now, if somebody's a 10 or a $50 million person and they haven't done any of these 3 cells and they haven't been introduced to real estate yet, maybe I'll make that effort because the reward is much higher. So I'll invest the time. But keep in mind, the higher the net worth of person you're dealing with, the more people that will be prospecting them. Not only more people, but also the higher the caliber person that you'll be up against. So it's not just about what you're saying to them, it's what is everybody else saying to this individual? And how do you stack up against all these other people? So if you want to go and pitch a $5 million person, go to events for $5 million investors and take a look around at all the professionals, and they will be pretty sharp. And then ask yourself, like, this is my pitch. What would my pitch sound like? And if it sounds like you're approaching it with tape and bubble gum and glue, and that's your slide deck, versus all these people that are, they got laser beams and all this other crazy stuff, and they're really essentially they're talking like economists, and that's probably, if you're at a $5 million to a $10 million client, they probably have some high-end economists that work at Fidelity or work at and listen to those morning calls and listen to what they sound like. Right? Because if you're getting to a $5 to $10 million client, you'll be up against people like me, right? I've got 10 years or 15 years experience in financial services, right? So imagine somebody talking to your client like I would, and then I leave, and then now it's your turn and you come in, right? So I'll give you an example of something that I might sound like, right? So I'm pretty current. So I'll talk to the client right now and say, well, Mr. Jones, one of the reasons why you want to work with us is because we're pretty in tune with what's going on right now. In the Wall Street Journal this morning, Jerome Powell said that the likelihood of raising rates is probably going to come a little bit sooner. They were probably saying that, as much as during the pandemic, they were saying that rates were probably rise in 2023. Now we're starting to see that the chairman is going to start pulling it in a little bit. The expectation is that rates will probably go in 2022 from a 1/4 point to as high as maybe a 1.75 by sometime in 2022. So what does that actually mean for you, Mr. Jones? Well, that probably means that what we're doing is that we're tracking interest rates, which is an incredibly important component of real estate. And we've already budgeted for increase in debt service. And so we've already accommodated for that. But the whole reason why rates are rising is because Jerome Powell is saying that they're probably going to keep rates, or probably going to keep inflation at about 4%, running it at 4% for 2022. A little bit higher than we like. The target's supposed to be 2%, so half of that, but a lot of it is probably related to COVID, right? Not necessarily systemic inflation. So the good thing about it is that we've budgeted for increased debt service, and we've been watching it on your behalf. And the second is that we've also realized that the result of that is because of inflation at 4 points or 4%, which means for us that we can probably match that with rising rents, or to increase the rents, which raises our rent rolls, which raises our profits, which keeps us kind of buoyant towards inflation. So we're protected relatively from inflation, but at the same time, we've also been tracking where interest rates are going, and we've also been making accommodations and budgeting for increased debt service. So that's why you want to work with somebody like us, because we keep those things into account. All right, great. Now your turn, right? So I just left the room. Now it's your turn. What are you going to say to that accredited investor, right? And that's just one snippet of what I would say. I could go on for hours talking like that, right? So if you want to get to higher caliber, you better make sure you know what other people are talking about, right? Or other advisors are talking about. When you get to mid-level, to high level, you're most likely going to be taking funds from somebody, right? Meaning that you're probably, if you're going to ask for $100,000 or $200,000 check, it's probably going to come from their JP Morgan Chase account, And that investment advisor makes a percentage off of that money. They probably will not let that money go easily. So they'll probably tell you, or they'll probably set you up for failure. So the call will pretty much go like this, like you managed to get that person convinced. So even if you got as far as, yeah, that sounds amazing, I'll get $200,000 check. Let me go talk to my investment advisor, right? Here's how that call is going to go. It's like, Edmund, we'd like $200,000 from our investment account. I was like, great, I'd be happy to send that. Of course, it's your money. I'll be happy to send it out. Oh, by the way, before we do that, where is it going to go to? Oh, it's going to go into this real estate deal. Okay, hang on a sec. Let me just, the reason why you pay me this money is to watch your back. All right. So first off, it's leaving a major institution, leaving JP Morgan Chase. And where is it going to? What institution is it going to? Oh, it's going to this guy that's never raised capital before, and he's doing a real estate deal. It's like, and how long has that person been doing it? Oh, this is his first raise, or they've been doing it for 5 years. They've been doing it for 5 years. JP Morgan Chase is probably as old as America. And you want to put it in there? And well, okay, fine. Like certainly you can, but let me ask you this: if you want to get your money out, how do you get your money out? Oh, they said I have to hold it for 5 years. There's a 5-year hold. It's like you realize that if you ask me to sell your investments, I can get it out in 3 days. There's if you have zero liquidity, that becomes a problem. That's a huge problem, right? Now, if you want real estate exposure, by all means, I can put you in a real estate income trust, and in a REIT, I can give you 3 days. And it stays at one of the largest institutions in America that's insured and backed up. Why are you putting this? Like, how well do you know this person? Oh, I just met them last month. You just met this person last month. You and I have been working together for 5 years. It's like, you know what? Let me handle this. I will give you exposure into real estate if you want that. I'm not a big fan of real estate, but I can put you in there. But at the same time, let's make sure that we get 3-day liquidity, right? Now you're toast, right? And that is at the mid-level. The reason why I can speak like that is because I was one of those investment advisors, and I can speak both sides because I was raising capital for real estate, but at the same time I was a licensed stockbroker. So I know what people are saying, and I know how to combat that. And I can play the other side too. And I train people on how to go up against those investment advisors.
You have tons of experience. You are well-versed, very experienced person versus somebody who's starting barely new or been for a year or 2 years in the real estate industry. So there's a huge gap, the learning curve, the experience. So how would somebody mitigate that gap and get into your lane or closer to your lane?
So one of the things that I teach people to do is become a person of value to your avatar. And if you don't know what that kind of value could be, a good default is to become a person of knowledge. And that's why I explain to people, if you are not reading the Wall Street Journal, that's kind of like the industry standard. So if you're going to pitch against mid-level, especially to family office, I don't know a mid-level financial manager to a family office manager that is not up to speed with the current financial news. And the reason why I say the Wall Street Journal, and I don't mean the Wall Street Journal, just like the website, I mean the Wall Street Journal, the print. So what I do is I get the Wall Street Journal print edition just digitally on my phone every morning, and I go through it. And the reason why I do that is I can scan the newspaper very quickly, because I look for how much real estate or how much space do certain articles take. And if something's taking up half the page, I know that's probably an article I got to read. So I go through the main titles. So I know what the discussions that's going around on Wall Street right now. And I kind of know what most people are talking about, right? Because right now there's a whole bunch of talk about, was it Evergrande and the sort of like the debt that's the Chinese debt that's going on. It's kind of a bit of a blip that we saw earlier this week, and the markets have sort of corrected themselves. If you're in real estate and you don't talk about those things, mid-level to family office, you'll get kicked out of the ring really fast, right? Because like if you don't know that there's a debt issue right now in China in the real estate realm on debt, like, you know what, then you're not really in tune with what's going on. You might get away with it for newly accrediteds. You won't get away with it in the mid-level to high level, right? So it's being able to understand the current news of what's going on. That's one. Somebody asked me a question, is it worthwhile to go to leisure or social events where there's a lot of high net worth people there? Absolutely. That's how I did it, right? That's a big part of how I did it. So not only do you go to those places, but try to, first step is try to blend in, where people think you're an accredited investor if you're not, but think you're also an accredited investor with them. So take a look at the room when you go into this room with all these high net worth people, and ask yourself, do I blend in? Can I match everybody? That's the first thing. Just try to match. Then the next is, as you get there, try to increase your social status in that environment. It does you no benefit to be a wallflower, to be like a black tie function, but nobody even realized you were there. The best way to network in a high net worth environment, like a black tie function, is to be the main speaker, the keynote speaker. So if there's like a 15-minute keynote speaker, and you're like, or you're one of the hosts of the evening. So I started in, I'm on the board or one of the committees at a national museum here in Toronto. So whenever we have functions, I'm supposed to be one of the hosts. So I sit there and I'm one of the committee members, and I'm supposed to introduce, or I'm supposed to go in and talk to all these new people and say, oh, I sit on the Young Patrons Committee at the ROM. And, are you having a good evening? And I'm supposed to be one of the hosts. And so my social status increases. And then I've been doing that for almost 10 years now, where everybody that shows up at these things knows who I am. It's like, oh yeah, that's Edmund. He's on the committee. There's only 7 committee members, and he's one of them. And it's like, and he just came to talk to us. Oh, Edmund's here, and everybody just hushes and quiet. Whenever time I go up to a group of people, I'm just like, hey, everybody, and everybody just like quiets down, and then they just listen to what I say. Right? That's a great example of different events. I've got some coaching clients right now that are equestrians, so they go to horse races and all these types of things. So that's a great environment to go to a horse race, and then have they would love to have high net worth investors there, because those are great gamblers too, right? So if they're throwing a social event, I used to do this too at one of our racetracks that are here. They were throwing a social event to go in, and this is a Woodbine racetrack. They were throwing a social event. They say, Ed, do you know any high net worth people that would want to join? It's like, yeah, I could invite a whole bunch of people. So I invited like 20 people to show up, and they came in as my guest, and I was their quasi host. I didn't do any effort or any work. I didn't have to arrange anything. All I did was, just when you go to the front door, just tell them that you're one of my guests, and that we're over in this corner. And next, I had 20 people surrounded. Everybody's kind of black tie. We're all drinking champagne, and it was all on the Woodbine racetrack, because they were trying to attract those kind of people. So I kept it relatively simple. I didn't have to go and do all this party planning or event planning. I just went to an environment that also could utilize the types of clients that I had. And that's creating a social environment where you have a higher social status, or you stand out, right? That's great networking in that sort of demographic, right? So hopefully that helps.
Some questions in the chat.
What are some great conferences that high net worth attend? They go to the family office conferences. Okay, so I don't know too many in the US for high net worth events. What I think would be more important is understanding your avatar, focusing in on a specific avatar, and then going to environments where it is rich in that particular avatar, right? So give you an example. If you decide that, like Vinky, if you decide, oh, my specialty, because I can speak the language, I'm a tech person, my avatar is a tech startup or somebody in the tech world, right? Then I would go to Palo Alto, I would go to Boston, anywhere where there's an incubator or a accelerator, and you go into those environments, and then become like a keynote speaker on how to grow your company successfully, and how to raise capital, or how to find investor dollars. And because for me, I used to do that just for fun. I dipped a toe into the angel investor in the VC space. My background is all private equity. I prefer it to be private equity. VC is my weak point, but I recognize that there's a lot of similar skills there, because they talk to the same demographic. They talk to this angel investors, are essentially accredited investors. So I lent my skills to tech startups, because really what I was trying to do is help them become successful. Because if that tech startup becomes a unicorn, eventually what they're going to need is they're going to need a financial advisor, or they're going to need a financial professional to help them manage their money. So it would be in your best interest to go and network in that kind of environment to see if you can get any of these rocket ships to take off. And if you do, then, and they become a unicorn, you're already on their board of advisors, or you've already been they already get comfortable with you, and they kind of know you. But if they become a unicorn, as soon as a company becomes a unicorn, there's going to be 1,000 people that are trying to knock on their door to manage their money. And you've already got a head start, because you were probably one of the catalysts to help them become successful. So for me, part of it was doing a couple of different things when I was prospecting. One is prospecting the Accrediteds of today, And that can be a very high wall, especially if you're trying to hit a $5 million person and you've never closed a $5 million person. The second best way is to go a little bit further upstream and look for people that have a high probability of becoming a $5 million person and getting to know them now when nobody's talking to them, right? So somebody who's worth 900,000 but has a great app idea that you look at is like, hey, this person's going to fly to the moon, right? This person's going to be running a unicorn. So don't put all your chips on that one client, but at the same time, spend some time just to get to know them and encourage them and check in with them on every quarter. And when they do become a $5 million person, they're going to be the first person that you talk to. That sort of gets into how I ended up managing money for a $25 million lottery winner. Because people used to ask me, Ed, how did you close a $25 million lottery winner? Well, I can tell you right now, if you wait to see the newspaper to say that this, and they have to do that here in Ontario, as soon as you win $25 million, they put you in the newspaper. And as soon as that person's in the newspaper, he had to cancel his phone. There's just so many people that were calling that individual. So that $25 million person came and reached out to me. And the reason why he reached out to me is because I knew him before he managed the money. And what he was is he was a property manager. He was a gardener on our property, right? At our investment firm. And for me, I would just spend lunch with the people. Like I go downstairs, and there's a whole bunch of people that were just doing the groundskeeping, and they're also eating their lunch. And it's like, what, these are really funny people, right? So I got out there and I really broke bread with them, literally broke bread. We all kind of ate together at every lunch, and we're goofing around and we're joking around. It made me feel like I was back in the military. It was that kind of camaraderie, right? And they knew, all the workers knew what we did, and they said, like, Ed, you're the only suit that comes out here and talks to us like a human being, right? It's like, you're awesome. And I was like, yeah, you know what? It's like I was in the military. It's like if I had made a few different choices, I'd be digging trenches with you, just because I used to do that for 10 years of my life, right? It's pretty much the same thing. So real salt of the earth people, we're all goofing around and joking around. And then wouldn't you know it, I didn't find out, like I just find out that this one guy ends up winning $25 million, and he pulls me aside and he says, Ed, I've been watching your investment firm for the 5 or 6 years that I've been working for you guys. And I'm convinced that if I ever won the lottery, I want you guys to manage my money. But I don't want your boss to do it, because your boss has been a jerk to me since the beginning. Like, he's a complete, you're the only guy that talks to us like a real person. So I want you to manage my money. And that's how I closed it. So, and in that exercise, and I wasn't really intending to do that. I was just being a genuine person, but it started to make me realize that the people that have a high capacity or high potential to become high net worth, or even ultra high net worth, like the 5 millions or the 10 millions, just keep going upstream. And once you do that, because when I started prospecting for that, one of the things I did was I talked to a lot of my clients that were multimillionaires, and I asked them, what did you look like when you were 20? Like, what were the core beliefs that you had? Why were you convinced that you're going to become a $10 million person, so on and so forth? And I started to see all the similarities of what they looked like when they were in their 20s. So then later on, what I did was I looked for 20-year-olds that had the same core values as the people that had $10 million. They just kept telling me, this is what I looked like when I was 20. And it's like, you know what? In this room, I see 3 of those, like out of a room of 100, I see 3 20-year-olds that had those same characteristics. I'm going to focus in on those 3 20-year-olds. And because there's a higher probability that they're going to be accredited investors, if not ultra high net worth. And that's what you do. You just keep looking for what are the potentials. So it's not just who are accredited today, who has a high potential to be accredited tomorrow, and then help them get there faster.
Excellent. I think, oh my God, you're just dropping the knowledge bombs. That's what I have to say. Oh my God. And everybody's, I think, surely getting the notes, but I just wanted to remind you that we have a recording as well that I will send out later on, and I'm going to charge you $100 per piece. Just kidding. Because he's such an awesome guest, and I'm pretty sure everybody's trying to create a framework for themselves, how they wanted to start or where they wanted to start. So anybody has any questions for Ed at this time, please unmute yourself and ask him directly. And in the chat too, let me see if I have any questions.
Hey, Ed, this is Jim. Curious about what your opinion is for people that are new to capital raising, or maybe just been in it for a short period of time. What do you think is the biggest mistake that people make?
I think the biggest mistake that people make is that they don't fall, or they don't create an image of themselves that their avatar is expecting to see, right? So right now I'm wearing a hoodie, okay? And if you take a look at even a picture that Vinky used, right? I showed people my finance picture. So I'm wearing a 3-piece suit. And I think even Angel said, it's like, I'm so disorienting seeing Ed like that. Well, that was Ed, the financial service, like Ed, the stockbroker, like raising capital. So for me, what I did is when I went to events full of my peers, so I would go to Bay Street, which is our Wall Street, but I would go down to Bay Street events for financial advisors and I would take a look at the room, right? Everybody's wearing a suit. Everybody looks like Harvey Specter. So I asked myself, it's like, okay, what you want to do is you want to look just slightly better than your peers. Not too much where you're just like ridiculously flamboyant, but you just look a cut above the rest. And that actually worked because when I went to different events, people would come back as like, this whole room is full of financial advisors. And for some reason you stand out. Well, it's because I got like a bright pocket square. That's as far as I would go, right? So 3-piece suit, bright pocket square, well-polished shoes, right? And from those, I stood out from my peers. It's the same thing that you work out right now, that whoever you're talking to in terms of your avatar, whether it's newly accredited, whether it's a $5 million person or a $10 million person, you've got to ask yourself, who else are they talking to? And what do those people look like? What are they expecting one of their advisors to look like? And if you don't look like that, well, that represents risk. And risk in that environment tends to turn into a no. So if you don't look like them, I'm sorry. Right now, for me, there's some things I cannot change. I cannot change the fact that I'm Asian. Okay, so maybe my client or my avatar. So that's the other thing too. Is like, what do you look like to your avatar? So what do they think when you step into the room? And then what do they say when you step out of the room? What do they say about you? Right. So there's certain things that you can adjust. Right. So for me, one of the things I recognize is that, okay, there's two objections that I used to get when I first started out. One of them was, Ed, you look young, right? So I'm Asian. You tend to look 10 years younger than I actually am. So when I was in my 30s, people thought I was in my 20s. And they would say, like, Ed, you look younger than my kids. And I don't even tell my kids how much money we have. Why would I trust you? Okay, so I need to get over that. And the other is I commonly got questions like, where are you from? Right? Which basically meant, in my understanding of it, is what's my cultural background, right? So I needed to get their comfort, and that's why I came up with that answer, which is I was born and raised in Toronto, and my last name is Money, but I also said that I served 10 years in the military. It's like, whoa, you sound really westernized now, right? So I spent 10 years in the Canadian military. I was a boot camp instructor. I don't sound all that Asian and immigrant-ish, right? So I kind of balance that out to give people some comfort. Right. So it's to understand, how do I make my avatar comfortable? Right. It's like, I'm not a threat. Don't have to worry about me. Let's talk about finance, that type of stuff. Right. And then build that bridge, make that gap. Now, if I came in and say, like, where are you from? It's like, what does it matter where I'm from? I'm Canadian. Right. That's kind of prickly. And that person in the back of their head is, how quickly can I get out of this meeting? And you're probably not going to pick up a check.
I just raised capital for the first time and was actually pretty successful, and kind of reached out to everyone that I've ever met in my entire life. And part of me feels like I've kind of tapped the faucet a little bit, and I have another deal coming up pretty imminently. What are your thoughts on going back to people that you just raised capital from and telling them that there's another deal on the hook before you've even been able to give them distributions from the first deal?
Yeah, that's going to be a hard ask. That's going to be pretty difficult. So for our investment firm, though, we had two ways to raise capital, or two main efforts. One effort, and your easier effort, is going to be your investor relations. Really good investor relations is really capital raising. And what I call this mining the diamonds in your backyard, right? So the time and effort required to raise capital from your existing investors is much easier than to find new investors. However, you have to give them some returns. In fact, what we ended up doing is when we had our first distributions, we insisted that nobody could do direct deposit for the first year. And people say, well, this is so annoying. Like, why do you keep insisting on mailing checks? It's like, because we physically want you to see it and physically go and deposit those checks, right? For at least the first year, because if it goes to direct deposit, you can completely forget and it can get buried into all this other stuff. So we went even further to say that it has to come as a physical check for the first 12 months. and then they can see them. Then it becomes a little easier to raise capital. The more checks they have, the easier it is to raise capital from that group. However, you don't want to keep doing investor relations because there is a limit to how much that group can potentially invest with you. And you do have to do a bit of both, right? So you do have to onboard new clients. So onboarding new clients at the same time, raising capital from existing clients, provided that they have checks. If you haven't given the distro yet, I would agree with you. You're not at that phase yet. You really need to keep onboarding new clients and bringing in new clients. So what you're trying to do is you're trying to develop, and once you've raised your first thing, what you want to do is you want to replicate yourself. And in the industry, we call this creating centers of influence, or COIs, right? Creating a center of influence is somebody who has a lot of connections with your avatar and can refer those people in, right? So for me, one of my COIs is an accountant, right? So I worked really well with accountants because I'm a tax specialist. A COI for me, a poor COI is not an investment advisor, because an investment advisor is a competitor to me, but an accountant and a tax lawyer are probably closer aligned with me. So I had one, how I develop an accountant as a COI is I ended up having 2 clients utilizing that accountant as their tax filer, right? And he had to call me and ask me questions about how the tax treatment worked on this, and I sort of explained it to him. And then he got to the point where he said, "Can you come to my office and explain it better?" So I said, "You know what? He's managing money for 2 of my clients. Probably I should get him on board." So I pitched him, and eventually he said, "If it works the way it does," and I've been filing this person's taxes for the last 2 years, so I've been filing four tax returns, and it does work. Absolutely. I want to be, sign me up. I want to be an investor. So I signed up on as an investor, and then I realized his entire portfolio is all my avatar. Every single one of his clients is one of my avatars. So would you imagine when I ever have a social event, I invited him. So I said, you know what, Lloyd, we have a social event. You're my first call. Please come and invite anybody you want. And certainly he would invite 5 of his closest friends, which were his clients, which they knew the most. And he's now that here we are at the racetrack. I'm meeting 5 new people that are that accountant's avatar. That's a great COI. Make sure that person's well fed. That's how you do it.
Very nice. Very nice.
That's awesome. Thank you so much.
Yeah, you're welcome.
Yeah, actually, I have a question. This is Travis.
Yep.
Is raising for a fund different in any way than raising for specific deals? I've raised for specific deals. I've never raised for a fund, but I'm really interested in starting a fund of funds. And what I'm trying to figure out is the overall approach to my existing investors as well as bringing in new investors.
Right. So for me, my style of raising capital was more like raising capital for a fund. And I work with some of my clients like this right now, and it kind of shocks me a little bit where they say, "Oh, I'm not raising capital until I'm under contract." And it's like, well, why do you have to wait till you're under contract? I don't understand it. It's like, oh, because I have to show them the property. And it's like, oh, I get it now. It's like they're trying to sell it like they were a real estate agent. But for me, what I told them is like, I'm always raising capital, whether we're under contract or not, because what I'm selling is I'm selling the structure and I'm selling the range, right? I say, well, we are raising capital right now for a deal. I don't know what it is, but we have a sort of perspective. We have a boundary. So even though I was here in Toronto, our specialty was Dallas-Fort Worth. So I would tell our clients is like, hey, I don't have a deal right now. We've got a portfolio right now. Most of it, if not all of it, is in Dallas-Fort Worth, right? So it's very likely the next deal that we're going to get is going to be a DFW property. It's probably going to have 100 to 150 doors. That's what we're looking at. We're on a short list with Marcus and Millichamp. They keep showing us every one of these comps, anything that hits this sort of parameters. And if it hits that parameters with this cap rate range, we'll be getting a 7 or an 8% cash flow with a 20% cap gain, right? Year over year, right? And it's a 5-year hold. Would you be interested if it looked like that? Because here's the thing, even when we were under contract, I would be really reluctant to show them the property. Like, well, yeah, here's the address. If you really want to do the diligence, this is the address. But I don't want that person to fly down there and walk the property, because it's like anything can spoil the deal. It's like, you know what, Ed, I'm not going to invest in this deal because I don't like the shape of the windows, or I don't like the carports, or I don't like this, I don't like that. And it's all about the bricks and wood. I'm not selling the bricks and wood. I'm selling the investment. And as long as you trust me to say that regardless of what we get into, we are confident that when we fit the engine into this investment, it'll get you to where you want to go, right? Do you care what the engine, like, as long as it produces with that cash flow, do you care do you really care what kind of real estate it looks like? Because you're not going to live there. So why do you care what color the doors are, right? As long as I can promise you a 7% return, right? So that is more like fund selling. And it would seem to be the flavor of the season or the flavor of the year, because there's something called the SPAC. If you take a look at the overall market, SPAC is a special purpose entity, right? Corporation. And what it is it's a public company on the stock market that doesn't own an asset. Right. So it is like raising capital before you're under contract, except this is for public deals, a public company that owns no business. Right. And all this, for whatever reason, all these people keep dumping money into SPACs right now, right? Or at least in the last year or so, or the last 2 years. That's more like raising capital for fund. It's much easier. Right. For me, my focus, or I've been very successful as my focus was more on take a look at the structure, take a look at it'll be a range right now until we're under contract. And then once we are under contract and I plug in all the numbers and I do our underwriting, then I can tell you a more specific, it's going to be a 7% distro, not a 9% distro, right? Or it's going to be a cap gain of 10, right? But at least we'll tell them it's right now it's a range. Are you interested? And if you are, if it fits this parameters and it's going to be property in Phoenix or it's going to be property in Dallas, would you be interested? And if so, how much would you like? And sort of set that aside for me for now. Once I get under contract, then I will run the underwriting. I'll tell you exactly the numbers, and you can back out. You can still back out then, but then at least you sort of have it preloaded, right? That's kind of like raising capital for a fund. It's more generic. It's more based on the security, not based on the asset. Is that helpful? Okay. Any other questions?
Hey, I have a question.
Sure.
Hey, great information so far. So my question is, I haven't raised capital for any deal yet, or haven't even done any deal yet. And most of the people that I have in mind who I can raise the capital from, they are not familiar with real estate investments and what it can do for you. They're just pretty naive about that, basically. So how would you go about it? Would you first start by educating them about how the real estate market is doing, how real estate investment can be an awesome way of, getting good returns? And then what point would you do all that? Would you do all that when you have a deal, so that it's easier to explain them the numbers and show them the proof of what you are talking about? Or would you just start educating them first and then tell them that, hey, whenever I get a good deal, I'll run it by you?
Right. So if somebody has never or doesn't understand the value or doesn't understand the benefits of real estate investing, they haven't even started on that, 3 cells. And when it comes to those 3 cells, and getting somebody past those 3 cells can take a while, right? So why real estate, why syndication, and why you? You don't have to be under contract to sell. Like, first off, you don't have to be under contract to tell people, convince people why real estate and why syndication. Why is syndication better than investing in property down the street? And if you can't do that, then if you can't make that sell, then you've really got to go back to the basics, right? So that's not really our focus tonight. Our focus tonight is how to raise capital from that accredited investor in the syndication side, right? So I can pitch people, if I wanted to, I could pitch people, why is real estate so important? Or why should real estate be part of almost everybody's portfolio, especially if you're high net worth? That's one. The second is, now, out of all the real estate, why should you be in a syndication? And then finally, out of all the syndicators, why are you picking me? And I'll tell you why you're picking me versus anybody else that you can choose. So you don't need to be under contract to sell any of those. In fact, for me, like I was just saying, is that even when I was trying to close money for us, and why us, I would still do it even when we're not under contract. I would have it all preloaded to say that if the investment worked like this, how much of that would you want? And so, like, well, if it worked like that, I'll take 50,000 or I'll take 100,000. It's like, great, put it aside, because I'll probably have a deal within the next month or 2. And when I do, you'll be on my short list and I'll call you immediately. I'll give you the final details about the deal. You can do your due diligence, and then we just do the check. It takes about maybe a week to do that final under contract. So I can raise that capital real quick, but I've already preloaded everything. So really, it's got to be your choice in deciding how much effort do you want to put into it, right? So if you're new to capital raising and somebody's newly accredited and they don't even understand the value of real estate, but you've got nothing but time, go ahead. Why not go and try to explain to them all the 3 steps or all the 3 sales, But for me, if I had to raise, like I was responsible for raising about 15 million on an annual basis. And if somebody's saying like, I'm interested, I've never invested in real estate before, I'm kind of curious and I have $50,000 to invest and I have to take them through those 3 steps, I don't have the time, right? I've got a, I've got a $400,000 client that's knocking on my door. That guy is probably going to get first priority, right? But if you've never raised capital before and you've got all that time, by all means, practice and try to explain to people why is real estate so important. Is that helpful?
Yes, and I like the idea of just having something, a model to show to them, and then say that similarly, I will have something that will be a real thing. That I like that idea a lot. Thank you.
So, and to sort of help people out here, if you get to the first point and if I was to ask you, sell me on real estate, why real estate? And you have no answers, I would encourage you to go back and read Rich Dad, Poor Dad. Because a lot of my sales scripts for why real estate will be based on a lot of the material that you'll find in Rich Dad, Poor Dad, right? It's what high net worth investors, or for me, and I'll tell you this, when I was managing money for accredited investors, most accredited investors that I managed money for had 2 things. They did not make their wealth on a W-2. So they did not become wealthy working for somebody else. Most of my clients ran their own business or created their own business. And the second is most accredited investors I came across already was investing in real estate. So they already believed in real estate. So because that comes from 15 years worth of money management. So now when I come to a newly accredited investor, I'll tell them your portfolio, like if I see somebody who has $1 million in investable assets, let me take a look at your investment portfolio, and it's all invested in 401k and it's all invested in stocks, I'll like practically fall out of my chair. It's like somebody like you shouldn't have everything all in the stock market. It's like, what do you mean? It's like most of my clients say those 2 things. Most of my clients that are high net worth clients made their money not on a W-2 and invested in some portion of real estate. I would have expected you to have a second house by now. Wow, really? My friends are always trying to convince me to buy a house and buy an investment property. It's like, yeah, you're not the norm. You're the exception. Most people that I see with multi-millions typically have already started to invest into real estate. You're behind the ball, and then they start to sweat. It's like, man, I need you because I became a person of value. I told them what they're not invested in, right? But that comes with experience. So that's an example. So that's how I would sell somebody who's just newly accredited that hasn't invested in real estate. It's like, why aren't you? Because everybody else is. All the other high net worth people are. I'm willing to bet if you pulled out any kind of $10 million portfolio, there's some form of real estate in there somewhere. And if it isn't, it's in my view that it's not invested properly.
Thank you.
Right. Any other questions?
Ed, I have a question in Cedric here. So there are different types of level of capital raising, right? We talk about the newbie, intermediate, advanced, expert. So you're pretty much up there. I wanted to check with you, do you still have a gap between you and the ceiling? Is there anything you're working on, some challenges? And what is your main vision goal in the short term, the next 2-3 years? Are you still working on this or developing another stuff?
Sure. There's also another question in the chat there asking what kind of licenses that I currently hold. So I do not hold any licenses. So one of my new boundaries as a coach is that I'm retired from the industry. I do not manage money anymore, and I do not raise capital. And the reason why I do that is so that I can speak to pretty much anyone across the world, because financial services is a ridiculously regulated environment. So if I still have any kind of license, I would only be able to only be able to talk to people in my own province. I can't talk to Americans. So for me, I just put it all behind me. I manage our own portfolio, my own personal portfolio or our family portfolio, and that's it. And I cannot manage investor dollars. But because of that, I can now talk to and coach other people on how to do it. So where do I start getting into deep water is when we get to very large institutional money, right? It would probably be a challenge for me to talk to the New York Firefighters Association, right? Because they're like, I know, $100 billion. Like it's a massive group. That is probably a very high level or a much deeper level up. Now, I could probably hold my own. I do talk to some very well-known Canadian economists that are also featured on MSNBC, and I kind of hold my, especially if I'm talking about real estate. But other than that, for me to pitch like a 88 or $100 billion pension fund, probably a little difficult for me, right? That's probably my upper limit. Anything else? Any other questions?
Other questions, please take yourself off mute and ask. This is your chance. I think that was a lot of information, Ed. I think Margaret has a question, right, Margaret? I saw you going off mute.
Yeah, my question would be, kind of dovetailing what Cedric just asked. As we are out there talking to people, what should we be watching for, in the economy in the next year or two that you think we should be keeping our eye on? Of course, there's Evergrande in China, but is it the pending recession everybody says is coming? Interest rates are clearly going to rise. What do you think is the one thing we should be watching for the bellwether for the future?
Margaret, one of the things that I explain to people, so I'll start showing you some of my scripts for why syndication and why me. And one of the things that I explain to people is that, of course, I'm pitching a higher net worth. So higher net worth is principal preservation. So I'll tell you, like, say I'm pitching you as like, Margaret, one of the things that I'll tell you why I like real estate and the way that we manage our portfolios. The number one philosophy that we have is don't lose the principal. And at the same time, I'm still chasing high returns. So we're basically talking about alphas and betas, all right? So beta is about volatility and alpha is about investment return. So what I'm doing is I'm chasing lower than average betas, so lower than average risk with higher than average returns based on that beta. So I'm trying to beat what you could probably get on the stock market, but not getting that same volatility. That's why I like real estate, all right? And that's why I like real estate syndications. So what I essentially do is I'm looking like, because not all investment returns are created the same. I used to have prospects say, Ed, what kind of investment return can you make? And it's like, I'm not answering that question. It's like, why not? Like, because I know that if I say, oh, I can create a distribution of 7%, that not all 7% returns are created equal, because it's when I present a 7% return, I got to ask you, how much risk am I taking? If I'm potentially going to make 7% return, but I could lose 30, that's a really high beta. I'm not interested in that. I'm interested in a low beta. So I say, when I create a 7% return, my upper and lower end is probably 7.5% to probably 6.5%, or no distro at all if it's really, really worst case scenarios, right? So it's relatively stable. That's why I like real estate. There's not going to be this ridiculous amount of volatility, right? So you have to take a look at that. You can't just look at the investment return. You have to take a look at the risk that is involved with it as well. Because I used to have people tell me, it's like, well, I'm not interested in 7% return. I just made a 20% return last year in my portfolio. It's like, oh, you did? What was it invested in? Oh, it was invested in GameStop. Oh, it was invested in GameStop. Well, like, that was a bit of a roller coaster ride. It was down 75% at one point, wasn't it? And they're like, and how did that feel? Did you get a little bit of vertigo? Did you throw up your cereal? Like, it's like, yeah. It's like, well, one of the things I used to tell my clients is my 7% will be the most boring return that you've ever got, because it stays 7% and it just comes in like clockwork. I kind of like boring. You got a $10 million portfolio. Do you like boring, or do you want to risk the principal? Yeah, that's a really good point. That's how I started to close that stuff, right? So understand what your avatar it resonates with, what's their pain points, and understand like how can you differentiate yourself from those types of things. So that is an example of, that's why syndications, and that's why us, because we focus in on getting stable returns for lower than average risk with higher than average returns based on that risk.
Great.
All right. Any other questions?
I think there is one hand, Jesse Lang.
Yes, hello. Is it possible you could put your contact information? Are you on LinkedIn?
Yes, I am. Let me just put that in there. And one of the things that I do offer to people is that if you want to get on a 1-hour call, there's no charge for that. I'll be happy to chat with you just to see if we would be a good fit, or it's really me, it's giving back to the community because I have the time now to do it. And I want to help people succeed, right? So the more people that are in the industry, the better it is for me, because there's more potential people to coach, right? So by all means, feel free to reach out. There's my link in the chat there, and I'll be happy to chat with you for an hour if you like.
Okay. What state are you in, by the way?
I'm in Toronto. So I'm Toronto, Ontario, Canada.
Oh, nice. I hear it's a very nice city.
Yeah, it's the financial center of Canada. So it's our New York, and both my wife and I work on Bay Street, which is our Wall Street, and my wife is still in the industry. My wife is still a licensed advisor, and she works for a $200 million portfolio, or a practice that's 200 million. So I get to see that function on a daily basis.
Right. Have any of your clients worked with Morgan Stanley by any chance, or Goldman Sachs?
Those are US banks. Most of my clients are all Canadian. So we work with the top Canadian banks are RBC. I was part of Bank of Montreal, or BMO Nesbitt Burns, which is a brokerage firm. There's TD. There's only, essentially in Canada, there's only 5 banks, and my wife works for the largest one. So in the US side, yeah, like of course there's going to be Morgan Stanley, there's going to be JP Morgan Chase, all those top firms, but it's pretty much the same thing. It's the equivalent. Once you start getting into multiple 7 figures in net worth, you're going to be punching in that category. You're going to be working with investment advisors, managing that style of portfolio.
Okay,
Actually,
thanks.
Go ahead, I'm
Thank
sorry.
you for the question. Thank you.
My pleasure.
Edmund, I had one more question. Were you an operator, or were you strictly a capital raiser?
So I was a capital raiser at a private equity firm. So our private equity firm was mainly focused in on our proprietary real estate syndications. But we were also licensed stockbrokers at the same time. And the reason why we were licensed stockbrokers is that we could manage the portfolios as well. So I could manage somebody's entire net worth. And I was a senior partner. I became a senior partner at that firm, right? So we were our own syndicator, private equity, as well as an investment firm at the same time. And then we started to get into estate planning because our clients were starting to get older, and we all started holding life licenses as well. So I did a lot of tax planning and estate transfers utilizing life insurance.
Okay, got you. So the reason I asked the question is because I've been an operator on multiple syndications, and I'm really starting to look to pivot away from that to strictly focus on capital raising. It's part of the reason why I'm interested in setting my fund up. And the thing I wonder about is actually finding good operators, and I'm just wondering if you had any tips for identifying good operators of these multifamily assets.
Yeah, if you start becoming just a pure capital raiser and you're essentially endorsing or vetting other operators, you start functioning much like an investment advisor. So for an investment advisor, when I sit at a seat, I'm not involved in a lot of the stocks that I'm recommending, but I'm vetting them. I'm vetting them and I'm endorsing certain investments. So, but I have to have a really good reason why. So for me, and there's a bit of an interesting fallacy if people don't know this. For most investment advisors out there, or stockbrokers, money managers, they really don't watch more than 20 stocks. It starts becoming really difficult. If somebody tries to tell you that they watch 100 different verticals, they're lying. There's no way that you could know it in depth enough to be able to satisfy the SEC requirements of know your product, right? So they really only pick about 20 stocks that they watch, because you have to go through annual reports, quarterly reports, all this stuff. Can you imagine going through all those public documents for more than 20 companies? It starts becoming really problematic. Right. So for me, what I would do is like, these are my 20 picks. Right. And every once in a while, maybe I'll shift and I'll change one. I'll take one out or whatever. I'll shift it. But I have to have a good reason why those things. So if I was coming into out of all the owner operators or all the syndicators that are out there, why have I picked these 3 or why have I picked these 2? Right. And then I'm essentially what you're doing to generate your fee is to vet them. Right. So I'm basically out of the 30 you could pick, I'm going to water it down to 3. And this year, these are 3 syndicators. And out of that 3, they're going to be producing 2 deals a year. So there's 6 deals that I'm going to go through with a fine tooth comb on your behalf. And that's why I'm charging you a fee, or else you could do it too. But you're a doctor, you're a lawyer. Do you have time to vet 30 different syndicators and 60 deals? No, I'll do it for you. Right. So you essentially become their advisor, or your trusted advisor is what we call it in the industry.
There's a couple questions in the chat, Ed.
Okay, you want to read one out that looks good?
Sure. Hold on, let me see. There is one, Jessica Allen. She says, would you be willing to speak in our investor mastermind?
Yeah.
Hi, Ed, I'm Jessica.
Yeah, Jessica, why don't you reach out to me and connect with me on LinkedIn and send me a message, and I'll be happy to chat with you just to get a better idea
Yep.
what your mastermind's about and who's in it, and see if I'd be a good fit. I'd be happy to chat.
Perfect. Thank you.
Eve, you talked about, yeah, you're welcome. There's another question there. Eve, you said, could I raise capital for somebody else? Unfortunately, no, that's where my boundary is. So I'm a coach. I don't step on the field anymore. I can't step on the field. And I'm actually held to a higher standard because I'm a former registrant. So I cannot talk to investors, but I can train people how to talk to investors. I should be okay with that.
So once again, gentle reminder, I put Ed's LinkedIn in the chat. Please feel free to contact him and reach out to him. And also I do see a lot of new faces. Please put your information in the chat so you can connect with each other. You can also save the chat so you can connect offline with each other. Any other questions for Ed? And I think, Ed, you did a good job. Oh my God, it was such an awesome session. I really, really appreciate it. Thank you so much.
It's my pleasure. So if there's no more questions, let's see if I think there's some other messages coming in here. Thank you. Yeah, if there's no more questions, I'll just end it off with, feel free to, don't be shy about reaching out. I'll be happy to chat. Really just keen on helping other people succeed. The reason why I do that is one of my whys I borrow from Zig Ziglar. And he has this line, which is, you can have everything you want in life if you help just enough other people get what they want in life. So, and I really live by that. So my intent is really just to help people succeed and to help people grow, because one of the things that I realized, and this is one of the reasons why I left the industry, I had spent about 15 years helping ultra high net worth people become wealthier. And there's all this discussion and talk about this divide between the separation between the haves and the have-nots. And I started to realize there's a lot more. What I really enjoyed is mentoring new advisors, training new advisors how to become successful, how to build their practices. And when I do that, that person not only becomes successful, but all the investors in their tribe or their community starts becoming successful. And I recognize, you know what, that's how you can start to move the needle and try to bring these two groups together. So instead of having, incredibly high net worth family offices and show them how to make even more money, it's get to the mid-level and to the lower levels, help those people get up and close that gap. So that's one of the big reasons why I just love doing that and love chatting with people, right? And I'm convinced if I do that enough, I'll get enough clients. I'm not looking for everyone to become a client, but eventually if we do that, I'll get enough clients to really just to feed myself and have some nice, decent cash flow. And that's really all it's about, just trying to recreate myself and then give back to the community.
Thanks again, Ed. And just wanted to remind everybody, we do this every other week on Friday at 3 p.m. Feel free to reach out to Ed and I'll pick his brain. He's offering an hour session for free. So you might want to utilize that time for your benefit. And we do have, the second step is the marketing, right? How you create your branding. So we have an awesome speaker 2 weeks from now, Adam Gower. So he's going to take you through this marketing journey. So I will put it on the LinkedIn, the event. Please join. And I look forward to seeing you next time.